The market is flying, hitting new peaks. Every headline is screaming joy. But listen closely. Does this smell like danger? Are we walking blind toward the edge of a crash? This isn't about guesswork. This is about knowing the hidden pattern, the secret signal that has appeared before every major financial disaster. Today, I am giving you the 4 absolute, undeniable warning signs that every smart investor and trader needs to memorize. And most importantly, I will show you the life-saving strategies. First, if you want this kind of strategic advantage, do the basics. Hit the like button, subscribe to Zalwora, and tap that bell. Don't miss the alarm. What exactly is a market crash? It is not just a little drop, it's a disaster. We're talking about a sudden catastrophic loss, usually 20% or more, in the value of the main indice. Why do they happen? It's a toxic mix. Overvaluation, where prices become fantasy, severe economic imbalances like mountains of debt, and finally, one tiny external shock that sets off the chain reaction of panic. Most people lose everything because they react after the disaster has already hit. But we can look ahead. How do we spot the crash before the media even starts talking about it? The first and most obvious sign is a market that is simply too high. Overvaluation and market euphoria. A market doesn't stop climbing because it's tired. It stops climbing because it's full of unsustainable greed. The key number here is the price to earnings, or PE ratio. When the market's PE starts climbing well above 20, especially if it hits 30, guys, you are paying for dreams, not facts. When your Uber driver is giving you stock tips and people are borrowing money just to buy assets, everyone around you is talking about buying and profits. That is the time greed is completely in charge. It means the well of buyers is about to run dry. So let us list the 3 key indicators of an impending market crash. Number 1, overvaluation and euphoria. PE ratio above 30. Speculative bubbles and retail frenzy. Number 2, economic imbalances. Rising rates, high debt. The most important, inverted yield curve, 10-year yield less than 2-year. 3, technical signals. Declining market breadth, wick spike, fear gauge, and insider selling. Number 3 is the spark that lights the whole thing on fire, the external shock. The system is fragile and all it needs is one piece of bad news to trigger panic. This spark could be anything from major geopolitical tension to a grave policy mistake by the central bank, which rapidly forces investors to question the market stability and seek shelter. Let's look at the terrifying force multiplier, the liquidation cascade, perfectly demonstrated by the extreme market event of October 10, 2025, when a geopolitical shock caused the US S&P 500 futures to drop 2%, but triggered a colossal $20 billion wipeout in crypto. This massive and sudden collapse was not just about panic selling. It was about excessive leverage, where traders in futures and options were operating with borrowed money, controlling large contracts by only putting up a small fraction of the value, which is known as their margin. Now we must understand the core danger. How does liquidation happen in futures and options? When the market suddenly turns against your position, your broker or exchange monitors your margin balance in real time. And if that balance falls below a certain required threshold, the maintenance margin, they automatically issue a margin call, demanding you deposit more collateral immediately to cover the potential loss on the contract. If you fail to meet that margin call instantly, the exchange, without waiting for your permission, automatically forces the sale or closure of your entire position. This is the liquidation, to protect the exchange and the counterparty from losing money. An event that instantly dumps massive supply onto the market, pushing the price lower for everyone else. This mechanical forced selling leads to the terrifying liquidation cascade, Because that initial wave of liquidation pushes the price down, it causes other leveraged positions nearby to also fall below their maintenance margin level, which triggers their automatic liquidation, creating a relentless chain reaction of selling that spirals the market downward until all the excessive leverage has been wiped out, often erasing fortunes in a matter of minutes. External shocks rarely cause the crash alone, but when the system is full of debt and leverage, they always ignite the disaster, turning a normal pullback into a full scale catastrophe. Next, we look deeper at the structural problems. Economic imbalances. The market can look healthy while the financial system is crumbling underneath. Rising interest rates. It's like tightening the screws on the entire economy. It makes every single loan, corporate debt, home mortgages, more expensive. The most important indicator, the inverted yield curve. When the 10-year yield drops below the 2-year yield, that's the inversion. This curve has predicted nearly every major recession for decades. It is the bond market telling us the short-term future is terrifying. Now let's look at the market's internal fever, technical signals, the way money is flowing. One powerful sign is declining market breadth. Is the index being carried by just 5 or 6 massive companies while the other 495 are actually struggling? Then you watch the VIX index, the market's official fear thermometer. When it jumps from calm to angry, the big institutions are already buying insurance. And finally, if the corporate insiders are selling off their own shares quietly, you should pay attention. This is the spark that lights the whole thing on fire, the external shock. The market is overvalued, the economy is fragile, it just needs an excuse to panic. This spark is usually unexpected. It could be major geopolitical tension or a grave policy mistake by the central bank. Think of Black Monday in 1987. The panic spread in seconds due to new technology and mass fear. External shocks rarely cause the crash alone, but they always ignite it. They turn fragility into fear and fear into a stampede. The signals are clear. What do? The average person panics. The smart trader sees opportunity. First, buy in fear, sell in greed. When you see those scary red candles, that is your moment to enter. When everyone is celebrating, that is your moment to exit. Second, book profits in parts. Don't try to catch the absolute peak. You'll never do it. Take some money off the table. Third, always use a stop loss, especially in futures. Stop loss is non-negotiable. It is your safety rope. Fourth, never go all in. Avoid the temptation to risk everything on one trade. Your guiding principle, survive first, profit later. Now, let's talk about your biggest enemy, yourself. Why do people lose everything, even when the warning signs were clear? It comes down to two emotions, the cycle of greed and fear. At the top, greed makes you believe the price will go up forever, so you buy the top. Then, when the crash hits, the pain of losing money makes you panic, and fear forces you to sell the bottom. This is the oldest trap in the markets. Another mistake is anchoring bias. This is when your mind anchors the value of a stock to the highest price you remember. You tell yourself, I'll wait until it gets back to $100 to sell. But that price might not return for years or ever. Your loss only gets bigger while you wait. The solution is discipline. Your trading plan, your stop loss, your diversification. These are not suggestions. They are a shield against your own emotions. You must follow the plan, even when your gut is screaming otherwise. Remember, survive first, profit later. Keep your capital alive. For the long-term investor, your goal is simple. Safeguard your portfolio. Diversify your lifeboat. Make sure you have a balanced portfolio of stocks, bonds, gold, and crucially, cash or cash equivalent assets. Avoid panic selling. If you sell at the bottom because you're scared, you guarantee that loss forever. Quality companies will recover. You can't put a date on the crash, but you can be prepared for it. Preparation means you are in control. We've decoded the signals, the market's overvaluation, the hidden imbalances, the technical alarms, and the threat of an external shock. Now, I want to hear from you. Have you seen these exact crash signals in the market these days? Comment below and let's talk. Don't let the next crash steal your wealth. Subscribe to Zalwora right now for more essential trading and finance tips, and hit the bell so you don't miss a thing. Stay disciplined, stay prepared, and keep trading wisely. This is Zalwora. Thanks for watching.